That's right.
Mark Hanf.
Hanf, yes.
H-A-N-F. Thank you, sir.
But the market's very astute to those interest rate triggers, so, and so are the lenders, so they're probably sitting there going, you know what, I'm gonna get ahead of it.
Yeah, that's smart. So, can you read us the next 3 minutes and then,
What is that?
That's stuff from Rich.
So when
no,
you
it's
do
really good stuff.
you do your normal intro, and then maybe I'll do the setup for Richard
Okay.
to tell the audience why we invited him on.
Exactly.
Basically, for those of you who've taken advantage of that opportunity to get your appraised value lowered after the last crash, might be in for a little bit of a surprise.
And Rich has got a lot of good stuff, not only in this case Schiller, but with interest rates and,
Okay.
yeah, he's
Good.
good. Just
So we'll
mentioned
do a
before
good
you
real
got here.
estate show today.
Yeah,
That's
very
good.
good.
Yeah, well, and I've got. Okay, well then, if you know, you guys are obviously.
Now, are you still
chatting a
doing the
little bit.
sports trivia, just so I'm ready?
Okay, hold
Yes,
on.
absolutely.
Okay, so well,
Or no, not on this show.
Not yet.
We're
Well,
not
we
approved
do
yet for that.
sports trivia normally
they
on
record it
sports,
separately?
but no, because we just changed
Right.
To
the
KDOW.
station. Yeah, KDOW has not gone through their legal portion of being able to say that I can do the trivia contest yet. So
Right,
I'm
right,
not
okay,
gonna
I
do
just
any
thought I'd be
trivia
ready,
right
because last time it was like, 1963 Pittsburgh Steelers.
Yeah, I know. I always get them
Backup
wrong.
bench.
I never.
And I'm like, should I guess and seem like an idiot?
It's okay.
Or just keep quiet?
I just say Babe Ruth.
They know all the answers, they both have them written
I
down.
know, it's
so
like,
it's
what,
like, you know.
That,
I can always
share
feed it
now.
to you guys.
that email I sent you, did you happen to
Yes.
print it out at all, or let me
what-
glance at
what are-
that one more
What are
time?
strategies for writing purchase offers and getting credits and price reductions?
That's good. All right, yeah.
And Mark, yours is, why do borrowers have to pay a higher interest rate with you than a typical bank?
Got it. Okay.
All right,
New station, new listeners.
that's it. Okay, so this is our second show on this one. So the only difference I gotta watch the clock. We do 5 segments instead of 4, and they're all kind of hard breaks.
Really? Is that going to continue to be the case?
Unfortunately, yeah.
Really?
Yeah, I mean,
And
when
how
I say
long is a
hard-
segment?
okay, so it'll be 8 minutes, 9:20, 8:20, 9:29, and 5:23. Last one will be just sort of a summary of
We'll wrap up.
this wrap up. This is what is it? Tell them what you're going to tell them, and then tell them what you told them. Right?
Yeah.
That works. Okay, so everyone's good. Can everyone hear? Okay.
Yep.
All
And do you
right.
want to
I
get
think I'm
into? Again, we got a couple of minutes. We're
Yeah.
ahead of schedule. Do you want to get into the that assessment issue, kind of out of the starting gate, or Rich, did you have some other things you were thinking of?
Well,
Going
why don't you
over?
tell the guys what you were telling me about, like different things that
So
you're
there's a
talking
lot going on, we're doing electronic
I
reporting.
can't hear
Yeah,
Richard.
We're
okay.
doing electronic
Okay.
reporting.
Gotta get close to this.
Yeah, okay,
Really
so-
close.
And don't touch it.
Yeah, I know.
If you can see all that high tech,
I know.
I noticed
sticky
everything.
stuff there, the tape and the tissue paper.
So we talked a little bit about we're doing electronic reporting.
Yeah.
The values that we've seen in the declines and the recovery is very similar to case Schiller. I gave, which is right in front of you, like a 12-month of what the mean and medians are now compared to 12 months ago out of the assessor's office. Interesting topic, Santa Fe is looking at the prospect of reviewing their pre-sale inspection program. What does that mean? San Francisco's doing transit occupancy and tax and property taxes on Airbnbs and junior units.
Exactly, yeah, and there was also the graph that you showed that it's like 2006, going down and then just coming right back up.
Yeah, if you want to see it, and the sales volume is very similar to where.
This makes for good
it
radio,
is.
these graphs.
Yeah, but it's good for you guys
I'm
to
just
see it. I
kidding.
mean, this is Marin's like case Schiller, right?
Right.
So this is where we are now.
Above the
Yeah.
previous high.
Yeah, and it's
Yeah.
a steeper slope than the previous one before
Richard,
08,
let me
09.
ask you: Is your office seeing a lot of inquiries as the bills are going out from people going, wait a minute, I thought that why did my bill go up so high? Now they haven't gone out yet for the new year. Maybe you're working on that now because it's only
But we
August,
do two
right?
things. Everybody who's in that status, we send out a notice and tell them what that is before July 1, which we've already done.
This is the sort of thing we should talk on the air, I think.
Yeah, if you want.
We gotta use up all that time, right?
And in terms of how many apply, not so many now.
Yeah,
Because
you
not
said
most
more,
people,
yeah.
most people are astute enough to know that we're under water for them, and that if they apply, and we have a caveat on the application that says, you know what, if you apply and we discover, or you go to appeal and you're over, assess you upward.
Yeah, right, exactly.
So you get
Yeah,
tax
you've said Case Shiller a couple times. I have no idea what that is. What is Case
That's a
Shiller?
national
Am I-
index
yeah,
on
that's-
housing
that's-
prices.
Yeah, they're usually about 3 months behind.
Yeah, my stuff's commercial, so I don't do.
Well, they have commercial
yeah,
too.
Yeah, so
I mean,
Case
they
Shiller
do some
house.
stuff.
Okay, all right,
Yeah.
good.
Yeah.
Yeah, I don't know. All right.
Let me just push
Let's
this
clear
a
up my
little bit.
stupidity before we
No,
go
that's
live
okay.
here, please.
It is recorded. It's not live. Okay, you guys ready?
Sure.
All right. And I'll even say, Mark, why don't you introduce our guest for today? Okay.
And Richard Benson.
Richard Benson, yes. Okay, here we go. Welcome. You're listening to The Best of Investing on AM 1220 KDOW. I got to get used to that because this is our new station, isn't it, Mark?
Absolutely. We are not a new show, but we are new to KDOW listeners. Welcome.
Okay. So I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms, and welcoming back Mark Cooper, commercial broker from H&L Commercial. All right, so before we get into our special guest that Mark's going to introduce, I want to make a special announcement here. If you go to the Best of Investing website, we have an icon called Paintball. And if you click on it, you're going to get over 80% off on paintball tickets. It includes equipment rental and everything. So you just have to click on it and you'll see what I mean, okay? So Mark, you want to introduce our guest?
Sure. Today we've got, as our special guest, Richard Benson, who is with the Marin County Assessor's Office. And what we're going to talk about, among other things today, is for those of you who took advantage in the past, well, probably now, it's been a few years, but when the market dipped, crashed, whatever you want to call it, in real estate, many of you took advantage of the opportunity to have your home values reassessed. But what's happening now that home values have largely recovered, in fact, in some markets we're higher than we were back in 2007, in the last peak, there was a little known caveat to that opportunity to get your tax assessment.
Prop 8, I think it
Yeah,
was.
to get your to get your tax
Absolutely.
assessment. And so we're going to talk a little bit about that because some of you may be in for a little bit of a surprise when you get your tax bill this coming year. Richard, welcome to the Best of Investing.
It's great to be back. Thanks for having me.
Absolutely. So I was asking you off the air, is it a surprise for people when they learn that property taxes are capped at normally an annual increase of 2% in California under Prop 13, going way back to the 1970s. And most of us who are homeowners are enjoying that fact that you can't just arbitrarily see your property tax bills go up. However, for those who got a decrease in their property valuations as a result of the Prop 8, that annual restriction or limitation on property tax increases does not apply. Can you explain a little bit about that?
Sure. First of all, and it's a great question, but we've been in this environment for about 8 years now.
Yeah.
So realistically, it's probably not much of a surprise to most people in Marin County. And our office does a very rigorous job of trying to reach out and provide information on our website and through literature that we provide in bills and notices that they have information on this. Simply enough, you're right. The Prop 13 tax base allows an increase of 2% a year. That's the cap. It can be less than that, but no more. Where it's difficult sometimes for people to understand is that if you're in a Prop 8 status and you've, let's say, had a 10% reduction one year, you could go up 12% the next year because you had a 10% appreciation plus you had a 2% CPI gain.
And I'll bet
So
there's a lot
it's
of people out
conceivable.
there who think, no, once you go down, you can only go up 2% a year from that lower point, but that's not the case.
Not the case, and that's gone through court already. So it's been sustained that base year inflation compared to the factor base year is what we call it, to the CPI, is pretty much set.
They actually went to court on that?
Absolutely.
Wow.
So while it was probably a hit to your offices when it occurred, when all of those reevaluations and reassessments were approved, lowering the property values in, say, 2009 and 2010, maybe even 11, a lot of people took advantage of that opportunity, and that was probably a hit to the tax base. It must be good times now for the Marin County Assessor's Office as you're adjusting those valuations back up to market.
So as you know, we don't get a commission.
You're not dancing in the streets.
So you're not smiling too much. It's just probably more work for you.
Suffice it
Yeah,
to say, that was a really tough time for our staff, and they did a great job.
Yeah.
What had happened was we took multiple billions off the roll. We took 25% off the assessments of many of those properties that went back a number of years prior to that economic collapse, and they've been returning over the last several years. And what's interesting, though, is the major beneficiary of that are the schools who receive the income from property taxes, over 40%. The rest of it goes to general funds for all the districts, all the cities, all the counties. And now that will start to wean as we look in the future years. So one thing that's really interesting, both from a taxpayer position and government at large, is even though that will be slowing down, how will that impact us in terms of revenue to all the agencies and government that needs revenue? And will that manifest itself in more taxes, like special taxes, special assessments, bonds, initiatives that land on the ballot? And people can probably look forward to seeing more of those things. You don't have to go beyond the headlines of the paper to see how that will land on your ballots in November.
So, and you brought some interesting Case-Shiller statistical information with you on home price increases. What was that all about?
So Case-Shiller is a national index that tracks in regional areas these same types of increases from one year to the next, 1 month to the next. And actually, we've been doing that for at least over 20 years in our office and tracking that. So they really parallel each other in terms of the change in value patterns from one year to the next. And when people see that Case-Shiller index, it's really reflective of Marin counties as well. They pretty well parallel each other, except that Marin tends to be a little more on the positive side because it's more affluent in terms of its real estate growth and appreciation than some other areas of the Bay Area, which may be a little behind.
And now the Case-Shiller Home Price Index, it is a lagging indicator. Some people say it's as much as 90 days kind of behind in the times. But irrespective of that, what I've noticed certainly in the national and more specifically in the California and Bay Area regional indexes, that those rates of appreciation, which were hovering for most of last year in the double digits, 10, 11, 12, have now kind of come down into the single digits. In fact, the last report I read, we were a little over 7% year over year. Now, are you looking, do you actually get even more refined statistics for just the county of Marin, or are you looking at the whole San Francisco Bay Area kind of MSA, as they call it?
I get information from other assessors. I look at the Case-Shiller index. I look at every jurisdiction in Marin County separately and together, and I make those comparisons. We typically see at this time of the year things start to slow down. So what you usually hear in the news is a month-to-month comparison of either year-to-date or this month this year compared to last month or this month last year. And always, almost always in a normal pattern, it slows down a little bit in the fall and then picks up in the spring.
All right, tell you what, guys, we're going to go to a commercial break here. Before we do, want to make a little mention here for the Camellia Inn, which is in Healdsburg, and it's a peaceful place for your next visit to California's wine country. So you get a good night's sleep when you are awake, a sumptuous, I like that word, sumptuous, inn-prepared breakfast awaits you. I love these little bed and breakfasts. They have a nice little villa-style swimming pool, and check them out at 707-433-8182, or go to CameliaInn.com. Stay with us. The best of investing. We'll be right back. Right on the money.
So,
8 minutes.
So here's the volume pattern, right? The value patterns aren't measurably different. So this volume, this is, I don't know how many years, 1, 2, 3, 4, 5, 6, 7 years stacked on each other, right?
Yeah.
So this was the 08, 09, okay? But these value patterns are very predictable. Value follows volume, or vice versa. So we'll see it start to trail off. There's almost always a little October bump down here, right? I'm not sure what that is yet. Optimism before elections, you tell me. And then it trails off, and then we pick up again, and in the spring. And that's a pretty regular pattern. So when you see month-to-month comparisons here, you'll always see a little.
So this is this sale and volume. So
This is
price
sales,
and volume.
Sales volume.
Okay, but we're not seeing price. Like
No,
if I want
but
to
if you were to look at price, you might see the same thing. Except when you look at this one, this is basically the same data. Upside down, it doesn't look good. So when we talk about like the Case-Shiller, this is, they also use a moving mean. This is a moving mean that finds a number right in the middle of the,
Got it,
Mhm.
yeah.
and it's up over, this is December last year,
Yeah.
December the year before, this will be December this year. Right.
This one's off the chart here, huh?
Yeah, that doesn't matter. I mean, I can set the graph anywhere.
Yeah, I've been watching, what I'm looking for is the rate slowing down, and that's something that it
But on a month to month, it really doesn't
yeah,
matter.
right, it
You need to
doesn't.
look at it more,
Yeah.
a longer period.
What do we want to,
Okay, what do you want to cover in the second?
so I've got a little bit of
We'll
news
come back, we'll come back.
that might be interesting to talk about. This article, I don't know if you guys seen this. This was actually in Bloomberg Business Week this week. Silicon Valley elites get home loans with no money down. It just talks about a couple of banks, First Republic and San Francisco Federal Credit Union, that are now offering 100% financing.
Really?
Oh,
To
that
their-
sounds familiar.
to
Yeah, exactly.
Just before the
Go ahead,
crash.
Just
China.
right. They wait till the top of the market as we're cresting and looking, what's going to happen ahead. Now they decide to offer 100% financing. Anyway, I just thought that was
That happened
interesting.
in the
Here we go again.
Exactly. Feel free to, chime in.
Yeah, absolutely. Let's all, banter is good. So I've got, I love this housing. This headline. It's not a housing bubble. It's just expensive.
Yeah.
And then just got some interest rate predictions, which basically everyone's always wrong. They always think it's going to go up. They always predict it's going to go up by the end of the year, and for 3 years running, they've all been wrong. So
Okay, put your money where your mouth is.
That's right.
I'm in on that one.
yeah.
Sounds good. Okay, guys, here we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Mark Cooper of H&L Commercial. And we're going to allow Richard Benson of the Tax Assessor to sit in on this next segment here and chime in. Mark, you've got some interesting information, some article there you're looking at.
Well, yeah, we always like to share some articles we find of interest here at the Best of Investing. And since we've got a house full of real estate guys here today, let's keep the topic on real estate for the rest of this segment here. This headline drew me. This was in the Bloomberg Business Week last week. Silicon Valley elites get home loans with no money down. So so we all know that the last real estate market crash was largely the result of a credit bubble. That's generally the accepted blame for that crash. And I find it interesting that we're how many years into the real estate recovery? At least 5 since the bottom of the market. And in many markets, home values have gone beyond the last high from 2007. Why would banks wait until we're basically looking at the top of the market? In many markets, we're already seeing kind of prices starting to soften in the Bay Area. Many are predicting that maybe we are at the top, and maybe the next cycle is basically right around the corner. Why would they wait till now to offer 100%
I
financing?
wonder if it's all competition between the banks, It's kind of the follow the leader, too. Someone does it and then the rest of them
Well, we know that there's a ton of money out there, and and not only is there a lot of private capital sitting on the sidelines, aching for yield, but the banks themselves don't have as many loans in their portfolio as they did, say, 10 years ago. So the lead sentence here says, it turns out even the well-off need help in a housing market as crazy as the one in San Francisco Bay Area, and lenders are elbowing each other in a rush to provide it. So it names 2 banks here, First Republic and San Francisco Federal Credit Union, who are both right now providing up to 100% financing on houses costing up to $2 million.
So some of them used to go over 100% financing. Remember that?
Yeah.
There was someone had done like 100. One bank did like 120% financing.
Well, I love the quote from this person, a mortgage consultant, who was asked about this and said, lenders are so caught up trying to stay competitive and finding a market edge, they basically allow greed to overcome common sense. And as we all know from 2007 and 8, easy money does fuel and accelerate an inevitable credit bubble. So
Yeah, I think I could predict the angle here is that they're looking for those banking relationships. So they say, hey, open up a checking account, keep $200,000 or more in deposits with us, and we'll give you that no money down loan or something like that. There's always kind of a caveat. I'm seeing deals like that on car loans and lines of credit. It's like, hey, bring your business here, and we'll give you that line of credit. well, what we'll actually do is loan you your own money back.
That's exactly it. Yeah, with the line of credit, I was doing the same thing, and they wanted to get like $100,000 line of credit. And they go, great, put $125,000 in our 0% interest account. We'll do it. I said, why would I need you then?
Well, and actually, the reality, the story behind the story is that these guys, the banks, they're cherry picking the best of the best of the best borrowers. They're really going after the people who, even if real estate declines, even if they make 100% financing on an acquisition loan for their primary residence and the value goes down, they're not going to stop making their loan payments. These people are not going to take a hit to their credit.
But they would be non-recourse financing though.
Well, that's true. If they did walk away, that's right.
Yeah, if they did walk away. Versus like Mark, you're the other Mark.
The other Mark Cooper.
You're in commercial real estate, and mostly the banks would be doing recourse financing, wouldn't they?
We see primarily recourse. Every once in a while, have somebody like they want to buy a Dollar General or a Dollar Tree, and those folks are looking for non-recourse loans. But everything now is recourse. I think the banks have learned their lessons in terms of non-recourse deals.
What is financing looking like in the commercial market?
Well, I'm actually seeing some really great rates, and B of A has been super competitive. And every once in a while, I'll see a deal come through, and I do a couple different types of deals. One would be, a 1031 exchange. If somebody's got to place money fast. Another one would be owner-occupant, and we're seeing a lot of SBA loan with 10% down. I just did a deal here in San Rafael with the guy, and I swear B of A said something like, it was like interest only for 2 years, fully amortized over 10, and the deal was like 4%. It was a rate that I would see on a residential home, owner-occ type of deal. So I was kind of blown away at what B of A did, but I think Wells is now doing deals like that as well. If the people have income, they can get some great rates, and I'm seeing longer amortizations too, 25, 30 years on commercial owner-occupied deals on big buildings. Yeah.
Okay.
So what do you guys think? Do you think we're going to see a bump in interest rates, or is it going to stay this way for a while?
We've been predicting this for a while. Right?
Well, it's interesting. An article quoted Fannie Mae, who predicts interest rates fairly regularly.
She's always wrong.
Fannie Mae does not expect the Fed to increase rates until June of 2017. They're basically predicting that interest rate increases, as far as the Fed goes, are off the table for the next 12 months.
But now, Rich, before the show, though, you were kind of mentioning something that...
Yeah, I'm always curious when we go through an election cycle, if we see bumps in interest rates following an election rather than waiting for some period of time later. It'll be interesting to see how that plays out this year at the end of the year or the first quarter of next.
Well, my thinking on this is, if Hillary gets elected, it's just more of the same of what we've seen the last 8 years. Is that going to shock the markets? No. So I don't see anything happening as a result of that. If Trump gets elected, now normally you would think someone on the Republican ticket would have an impact, favorable economic impacts, I guess one might argue. But I think there's so much of an unknown with him and what he may and may not
really?
do. That might actually shock them.
The funny thing to me is it just seems like the Federal Reserve, each time they look at a bump, they've said, it's qualified to do a rate increase, but we're not going to. Mm-hmm. So when you add all those up over the last 12 months, it kind of makes me wonder whether that inertia is building.
Now, what if Gary Johnson gets in?
Yeah.
Or Pat Paulson.
Well, of course,
he always gets a few votes.
We had the big Brexit scare.
Yes.
Brexit scare. I can say that fast 5 times. Last month, and of course that really put a pause for a lot of economic activity. We had the stock market drop, which of course now it's recovered, but we had the Fed really react to that. That along with the slow growth economic numbers that keep coming out, and basically they are speaking as if they're not intending to raise rates, although they're pretty they're usually pretty mum about that.
A lot of it has to follow the economy in general.
But
they look at the jobs, the unemployment, the whole kit caboodle.
Probably the most interesting thing about where interest rates are heading is that pretty much everybody who has an opinion that is respectable in real estate in mortgage, they've all been wrong for the last 4 years. In fact, just at the end of every year, we do a couple of shows where we talk about predictions, market rate predictions, interest rate predictions, and at the end of 2012, at the end of 2013, 2014, 2015, all the interest rate predictions were almost identical. They were all predicting interest rates approaching 5% over the course of the next year.
And they all kept their jobs.
So do you guys think that there's anything in the market that's a good indicator, whether it's employment, CPI, or something else in the marketplace that can help the public or listeners understand what drives bumps in interest rates?
Well, I'm seeing something in the city, in San Francisco, which has been a leading indicator in my business, because rents go crazy in San Francisco, and then it trickles down into Southern Marin and kind of works its way up. What I'm seeing recently is things are starting to slow down in the city in terms of volume of sales, rates for leasing of office buildings, consumer confidence and business confidence starting to slow a little bit. So that's the first time I've seen in maybe a few years. I mean, I remember I'd say 5 years ago, I had warehouses all over Marin County that I couldn't give away. Now I've got people lined up on a waiting list to rent or lease a warehouse. But I think that there's something coming our direction where we're going to see a little slowdown in volume and values.
Okay. Guys, believe it or not, another segment just came and went. When we come back, we've got some very interesting emails for our co-hosts here that I know the audience will want to listen in. And don't go anywhere, because you're listening to The Best of Investing. Don't touch that dial. We'll be right back. All right.
No plug on the last one, huh? No Hampton Inn.
No, I was like,
wait, we forgot.
I've got something for the Weingarten children. They're having a masquerade party. A little.
So you can start with Mark on.
Okay.
Go ahead and shoot him his commercial one, and then do mine second.
Okay. Then we'll come back and we'll get another segment.
Now, when you take a break, is that like real time, real air break?
No.
And why do they have the segments like? Why are the segments like
So you
FCC.
breathe.
fatigue? Oh, it's
The
FCC.
FCC stuff is what they're giving me. Yeah.
Well,
I mean,
it's
weird.
funny though. What's on 9/10,
Yeah.
we could do 4 commercial breaks, 3 commercial breaks. Could
Yeah.
we have not done a commercial break and done just 48 minutes of straight radio if we wanted to?
I believe so, but they steal basically a certain part in the beginning, a certain part in the end.
Well, we know it's not a full hour,
It's not a full
Who's
hour.
they?
but
The
radio
station,
show.
radio
Yeah,
station.
yeah.
Okay.
And then they fill it with
here-
advertising or whatever.
Well,
they're
well,
doing.
the ads are ours,
Right,
Yeah,
okay,
they're
sure.
ours.
Which
Okay,
is great.
but they do steal.
But KDOW,
They
my
take
question
time
is,
to sell
why are
They
these
take
hard
some
breaks for us? Because usually we just
I
talk
know.
until we want to break, and then we break, and then we the only hard part is it has to be 48 minutes. So here they actually want
They actually.
But I think there's
They
some kind of
steal.
pacing of the conversation where it's not, because it would be getting monotonous. It's like these guys talking.
Oh yeah, no,
You're
that's
oh
why
my
it's
God, I
good
need
for
a
us to
break.
have breaks. But
I'd like to.
but
You shoot me while you're
We
working
got
on
it.
it. I just want to take a quick peek.
All these
Yeah.
visuals we're getting.
I mean, like with the sports show, that's an international show, and so they have to have hard breaks because of Armed Forces Radio. Here, I don't know why they have to have it.
it's like some kind of union thing or something.
something. Yeah, it's like.
Because if it's our commercials,
But no, they
why
take some
would they?
though.
Oh, they do.
They do take some local stuff. Yeah, they take like 11 minutes worth.
Okay.
I got KKSF only takes 6 minutes worth. These are supposed to take 11.
Yeah. Well, it's okay. Local content, 12 minutes. Program content, 47.50.
Well, what's local content? What
Local
it?
is them and us, but it's mostly us.
But they give you.
Well, no, they.
Oh no, the
they-
47.50 is us plus our commercials, right?
These guys always
No,
buy
that includes our
bandwidth,
commercials.
too.
Oh,
They're actually
So
taking
how do they get the
12 and a half minutes.
We need a whole show on talk radio so I can understand how this whole thing works.
Yeah, I know.
The
It's
regulations of talk radio? Yeah, that's
regulations. It was not just talk radio, but it's the FCC with just radio, and then they take some of our time to be able to sell it to some of their.
The FCC?
No, not the FCC. The KDOW.
Right, sure.
Yeah, they basically say you can buy an hour show, but you don't get an hour.
Oh, for sure.
You only get.
Oh no,
That's
we
fine.
and we
It's
all
weird.
know
These
that.
are the
That's
terms.
okay. And as Mark was
Absolutely.
saying, it gets monotonous if you don't break it up a little bit.
Yeah,
It
but
gets-
we should be able to break it up however we want.
right, I know.
They shouldn't
That's
take
what we
me.
did on 9/10. We broke it up when because some of our segments sometimes would go 12, 13, 14 minutes
Yeah.
because it was really interesting
Exactly.
stuff and good banter and we
Not
didn't want to
sometimes.
slow
It's
down.
always interesting. But
So this is segment 3.
this is segment 3. Yeah.
So 10
segment
minutes.
3.
So we got 10 minutes. We'll do.
Yeah. Now technically this one isn't 10 because I've got like your commercial in there.
Oh right.
So
Okay.
this one is going to be 8 minutes and 20 seconds.
Oh, so that 1 minute slice in there is them.
Now.
Okay.
I'm sorry. Yes. Local affair. See, we only get the segments to do with
Right.
what we want.
Okay.
They take they take station content and they take the local avails.
So the gray is them.
It's them.
That's why they want hard breaks.
Correct.
Okay, because KNEW did not do that during the course of the show. It was all our show.
Correct.
Got it. Okay. So anyway, so you've got you can
I'll start with Mark.
you can elaborate on your answer. You've got half of you've got basically got 4 minutes.
Yeah.
You can take half the time.
Fantastic.
So don't feel like you have to answer the question quickly and shut up. You can answer it. You can pivot.
Pontificate.
Right, well, you
Pivot a
can
little
pivot
bit,
a little
yeah.
bit
And,
and
you know,
use
we'll
it
plug
to
it
talk
'cause I mean,
about
yeah.
what you do if you want to. It's kind of the show is meant to try to give us opportunities to showcase our talents, right? I
Exactly.
mean, we're not doing this for fun. We're doing it to get more business out of it,
I
right?
don't know. Having fun.
Well,
Okay.
it's fun too, but it's still work at the end
That's
of the
true.
day.
Okay, ready? Here we go. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hanf and Mark Cooper. And let's see, we don't have any commercial, or excuse me, we don't have any trivia questions, but
Not yet.
not yet. Now,
Stay
maybe
tuned.
Stay
Maybe
tuned.
next
Maybe
week.
next week. So we have a co-host who's going to be joining us for the next 6 months. We go on once a month.
Welcome.
Well, yeah, to Mark Cooper. Now, just to give the audience a little tidbit, every month I go to a broker's meeting, right? There's probably 60 to 80 of us in this breakfast meeting.
It's commercial
breakfast.
brokers.
Commercial
breakfast.
brokers, right? And some of the guys there are pretty good. It's interesting. I mean, and this is before I knew Mark. I mean, I'm being truthful with you. I'm not just trying to puff you up here, okay? Even though the room is big enough for everyone here, all right? Literally, I noticed when Mark makes announcements, it's amazing how popular he is. It's not just because he's funny, but literally the business that
When
you
Mark
do.
Cooper talks, people listen.
Yeah, no, it's really it's really true. I mean, I gotta say that he always seems to be getting a lot of business for his clients. So that's a little intro to you.
So welcome, Mark, and you got an email question for him.
Yeah,
That's great.
exactly. Because we get emails all the time, and here's one that's right up your alley. What are strategies for writing purchase offers and getting credits and price reductions?
Oh,
That's
this is
a good
commercial
one.
property,
That's a
right?
good
one.
Commercial.
Yeah, absolutely. Well, in Marin, I do a lot of sales, probably about 12 or more sales a year, and I'm working with a lot of investors and owner-occupants. So I have some investors I work with, and what some folks will do is they'll make an offer of what they're willing to pay for a property, maybe come 10 or 20% less, do all their inspections, and they find something that they didn't know about or claim they didn't know about and ask for a big credit.
Yeah.
That's a technique that a lot of folks will do. They're asking $1 million, they offer $900,000, and then we get it and do an inspection, and needs a new roof. They ask for a little more money. One of my favorite investors to work with is a guy who's got a lot of cash, and what we will do, I'll send him a property. He'll drive by and look at it, and every time it's the same answer, either no or write it up, all cash, full price, 17-day inspection, 30-day close. Before we even go inside the building and before we even look at it, he doesn't want to waste his time. He wants to get it into contract. And that's a guy that I really like to work with because we want to make sure nobody else can buy it before we make up our mind if that's something we want to pursue. And then we'll do our inspections. We'll come back and ask for a big fat credit and decide should we just walk away or not. Because a lot of these things, there's 9 offers and this person's got financing and somebody else wants to pay more money and everything's going. So I would say a great technique is just to get it into contract before anybody else can, and then really decide, let's crunch the numbers and make sure this is something we want to pursue.
Now you said you do like working with that. I mean, how many times do you finally, do you find, oh, well, we need a $200,000 credit because of this, and the seller says, no.
Get
Well,
lost.
I think,
exactly.
I mean, it's tough. I know some residential people that'll do 1 or 2 big deals a year, and they've got so much riding on that one transaction. There's so much going on. If I'm working with investors and I've got 5 properties in escrow right now, if one falls out because we decide to not pursue it, it's not that big a deal. I mean, I want to do what's best for the buyer, and if their decision is to not pursue that property because it's got dry rot or whatever it might be, that's fine. My deal is not the transaction, it's the relationship with the buyer, and that's what's most important to me.
What if the buyer doesn't have all cash? Is there a way you could work with somebody who maybe can still make like a non-contingent offer? Maybe they got a private money resource or
Private money.
What a coincidence.
That's interesting. I just
I don't know why I would mention that.
Yeah.
I was just approached by a client who was doing an exchange. He sold another property, and he had about $50,000 in his exchange. So he had to buy something of either greater to equal or greater value
Yep.
of the debt and the equity. Well, what can you buy for $50,000? Not very much.
Garage, maybe.
This guy had he had a little bit of checkered past in a transaction, in the dip, and so because of that, it would be hard for him to go conventional and get another loan. So I think private money would be a great solution in that situation because we can close quickly.
Yeah.
And I mean, tell me what the differences are. I'm writing conventional offers, even 30-day inspection, 45-day close. Appraisals are taking forever.
Yeah.
What can private money do if I see a triplex that comes up and it's just too good to be true and I need to have it? What can you guys do there? How quick a turnaround for a good buyer?
In commercial, as few as 3 days, although we prefer 5 to 7.
Well, I don't work weekends, so that's all right.
I mean, going back, you said you usually do 12 transactions a
12
year.
sales.
12 sales. That's
Yeah.
a lot.
About one a month.
Yeah,
For
that's
commercial,
a lot.
that's a lot.
See, that's what I told you. So when I go to these meetings, Mark always has a few things going on, compared to a few of these other brokers. Or usually they'll just say, "Hi, my name is Joe." Next.
Well, I think a big part of that too is our leasing and tenant representation is I'll do about 1 or 2 of those a week. So I'll do 60 lease transactions a year, and a lot of those leases will feed into working with buyers and sellers. I've done deals where I helped a guy rent an office, and the next thing you know, you turn around, the 3-year lease is up, he's ready to buy a building.
Gotcha.
And then 5 years from then, he's ready to sell that building and buy another one, where a lot of agents are just looking for the big deal. They're trying to get in with the owners of the property. Well, that guy bought his property somehow. He had an agent. So what I do is I work with, it's kind of like nobody too small. I've worked with a lot of people, and their businesses blow up, and I'm ready to be their agent. And no job too big, no job too small. We can handle it.
Absolutely. So how do people get a hold of you if they have a question about commercial leasing, buying or selling commercial property? Sounds like you're a wealth of a resource of information.
Yeah. Well, am I crazy to get my cell phone out on the air? I guess I'm going to go. And we're just
whatever.
415-608-1036.
Carrier pigeon doesn't matter.
Yeah, 415-608-1036. Do not call me on the weekend. And then if you're going to go weekend or evening,
Well, of course, this is a Saturday show.
right?
So-
We can wait till Monday.
Yeah.
And then in the evening or weekends, email's great. Mark MARK at HLCRE.com.
Which stands for.
That I like to say, hungry lion crosses river easily.
Used to be
Okay.
home and land, right?
It was home and land commercial real estate.
Awesome.
But maybe you should change it to Hungry Lion. Everyone will remember that one.
I like the
It's got a
hungry lion.
ring.
Yeah, it's got a nice ring to it.
It does. Okay, Mark, we have other Mark Hanf this time. We have an email that says, why do borrowers have to pay a higher interest rate with you than a typical bank?
Well, not just with me. And by the way, I'm Mark Hanf. I'm president and broker for Pacific Private Money. We are a private money real estate lender based right here in the San Francisco Bay Area. We are an alternative resource for financing. We're kind of like the plan B when plan A fails. You should always get conventional or bank financing for your real estate transaction when you can. But there's an awful lot of situations that occur every day that don't allow you to use bank financing. Probably the biggest reason people come to Pacific Private Money is speed. They've run out of time, or they thought they were bank financeable, and their mortgage broker said they had a loan for them, and something glitched during the process. The worst time is when that happens after their deposit is gone, non-refundable, and they call me in a panic. So companies like Pacific Private Money, who are private money lenders, also known as hard money. Hard money is kind of like the old term for it that was used commonly 10, 20 years ago. We prefer the private money lender moniker these days because we think our business model is a lot different today than it was, say, 10 years ago. The biggest being, we're more regulated today. We are not the predatory lender, loan shark that you guys remember many hard money lenders were, say, 10, 15, 20 years ago. We're really an industry that emerged post-recession, post-crash. Pacific Private Money was founded in 2008, in fact. Now, the first couple of years were a little bit lean because I didn't know when I founded the company in 2008 just how severe the market correction was going to be. But we've been in business to basically provide financing for people when bank financing was not available. Now, why are interest rates for private money loans so much higher than bank financing? And on average in the San Francisco Bay Area, a private money loan is right around 10%. It can be less, maybe it's 9% for stronger borrows, and it could be more. But generally speaking, it's about that, and it looks like we're going to be hitting up against our next break right now.
We are.
I'm gonna come back and explain a little bit more about private money loans when we get back.
All right, stay with us. You're listening to The Best of Investing. Wow. Well, I got to really look at this clock.
Did you blow it?
Well, I did, but
Go
you know
over.
what? We're going to use that. That's actually going to be segment 4 instead of 3.
Which is fine. They won't know the
Fine.
difference,
No,
right?
Yeah, no one will know the difference.
Well, if that's segment 4, then I can't go back to talk about it. Well, I can use the last segment to
Why those rascals? Why does it have to be?
Hey, just pick it up on the last segment.
yeah, we could. We picked. We've got
Pick it up
5
at the
minutes left.
beginning of that.
Yeah, because I can wrap it up in a minute, and then we can.
How do you
you
want
got
to do
5
that?
in the
I'm sorry,
last. You got 5 in the last segment, right? So you
Yeah.
just get through that in the first minute or whatever it is.
I do
You're
have an
good to go.
assessor question, so I want to get that in.
Yeah, I
before
want to
we-
definitely get that. Okay, so I mean, could I? How do you want me to do that?
We can
I don't-
re-record what we just did? Or
No.
You're
it's
like,
not
no, never,
nice.
never.
Yeah, we never.
Only if we make a mistake.
Don't go back.
Yeah.
So
dating
yes,
your ex-girlfriend.
yes, use it for segment 4.
Okay.
Never go back.
So the next segment will be we'll talk with Rich and just talk real estate for whatever it is, the 10 minutes or 9-minute segments. You tell me what it is, and then when we do the last segment, I will finish up on my private money loan. Does that make sense?
I mean, you started this segment out independently of the former.
Yeah.
So
Yeah.
you can tie
This guy's
this
good.
segment
Yeah.
to the last and just use this next segment for segment, what would it be, 3,
3.
right?
Yeah.
And then you'll be fine, just so long as you don't do another continuation
So when you
get to the
when
end
you
of
do
this.
your intro, have Mark can go ahead and ask Rich a question.
Okay.
So it's as
Do you
if
prefer
we
Richard
picked up-
or is Rich okay?
Rich is good.
Okay, all right. I know Ed Word prefers
Yeah.
Word.
All right.
not-
Okay.
not
Okay.
Ed
So
either.
I'm actually going to save this as segment 4.
Okay.
Sorry about that. It's the first time I've heard
I mean, I think you might have said when we get back, we got some email questions at the end of segment 2, but
That's
nobody.
okay.
No.
You're like, wait a second, foul.
Yeah, exactly.
I'm sorry.
Well, just make your question an email question and you're good to go.
We got an email question for
Mark.
Rich, the assessor's office. Why are my taxes so damn high? All right, good.
But you've got a 8-minute segment here,
Yes.
so you need to figure out ahead of time kind of what you're going to talk about, or if you're just going to go freeform.
You have a radio background there?
I know. I was going to say you're
That's the
good.
guy.
No, but they had me here a couple of years ago, and so
Yeah.
it's like, you try to pay attention to these guys.
Right.
It's true.
got a
But this is
sharp
different. This is the first time I've had that too.
It was
You
just
have
getting
hard
so
breaks
good.
and
Yeah,
stuff.
the hard breaks usually it doesn't really matter. Okay, so this is something
Yeah.
for us to get
So
used
one
to.
of the things that's interesting, I talked about before too, I don't know if it grabs you guys, but these Airbnb units,
Yeah.
right?
Yeah.
I mean, they could be, in San Francisco, they're being subject to a transit occupancy tax, assessment by the assessor on the business personal property, and they have to take out
Okay,
business
so
licenses,
here's how I'm
et
going to
cetera.
introduce it. I'm going to say, I know we said when we get back we're going to do email. We're going to save that for the next segment because,
nice.
Yeah, that'll work.
Mark's got a question for
Yeah,
Rich.
that's
How's that?
Yeah, that's
Okay,
perfect.
All right.
Got it.
Welcome back to The Best of Investing. Edward Brown here along with Mark Hanf and Mark Cooper. Now, I know I told the audience when we got back we were going to go to email time. We are going to do that in the next segment, but Mark Cooper was just itching to ask Rich Benson, the tax assessor, a question. So we're going to go with that.
All right, I'll do my best here. So I'm aware that there's a grandparent and a parent-to-child exclusion, like if your family leaves you
Sure.
some property.
Right.
Okay. So how does that work if it is an adopted child? Is there any? Does it have to be your true blood child? What if someone is adopted and you want to leave them real estate? Are they looking at birth certificates?
Tricky. So in general, kind of the common sense approach is the way the rules are set. So parent-child means parent-child. Grandparent means just that. So if there's a parent alive on a grandparent-child, you can't get there without going to grandparent to parent and parent to child first.
Okay.
So the rules on the grandparent-grandchild is that the parents have to be deceased for it to go from grandparent to grandchild. On parent to child, it has to be a natural child or adopted. So anything that generally interferes with that normal kind of relationship between parents, child, grandchildren could block that transfer. And another one that's very interesting is on parent-child transfers or grandparent-grandchild is relationships between siblings, because transfers between siblings are not exempt or can't be exempted. Actually, excluded is the right terminology. So when parents transfer to children, there's a step there where sometimes the children kind of get trapped because they haven't figured out a plan, or there isn't enough other assets to offset the real estate that makes it a transfer between siblings after it's been transferred.
Okay, so with all this complication, what's your hourly rate for people to come in and get advice from you?
Most all this stuff can be found on our website. There's FAQs and other information that we provide. It's pretty easy to obtain, and I always say that the best way to get it is ask the question first.
And of course, we love it at Pacific Private Money when siblings inherit property and they can't agree what to do with it, because one of my favorite loans is making loans to someone who wants to buy out the interest of his siblings' interest in a property, and so
He wants to live there.
right, right, or it might be for a number of reasons, and oftentimes some siblings want to cash out, others want to sell, some want to keep. It's all kinds of reasons, and the banks won't touch those loans with a 10-foot pole.
So that's really a key factor, because especially in Marin County where we have lots of trusts, one of the things that can help facilitate that is if the trust borrows the money and then it moves the property from one sibling instead of to both siblings, but the trust has borrowed the money, then that transfer becomes siblings can be non-assessable and not trigger reassessment. But once you've already moved it out and it's not the trust that's borrowing the money, it turns out to be one sibling is borrowing money from the other or something like that, then it won't work.
So it's not the substance over form type thing.
It does not here.
And that's actually really important.
Yeah.
That just if you're in a situation like that and you're listening, you really should consult a good real estate attorney to help you with that, or a estate planning attorney, probably even better still.
There's also a lot of information on this stuff at the State Board of Equalization website. So really there is a tremendous amount of information for the public to garner from lots of different places, private professionals, State Board, Marin County Assessor, etc., to help see your way through this forest.
Is it easy to understand? On the website?
Yeah, it's written so you can understand it, and the FAQs are designed to be able to help everybody.
So we're talking with Rich Benson, the Marin County Property Assessor from the Assessor's Office. And Rich, off the air, we were talking a little bit about how Airbnb has kind of infiltrated your attention span, and you talk a little bit about how that's been impacted your office.
Well, it really hasn't hit us yet, except when we look about assessments and the regulatory framework, we usually are somewhat behind the market in general. San Francisco has been kind of the leader in this area with Airbnbs, and one of the things that's pretty much established is that once somebody starts using a piece of real estate like a home for an Airbnb, it can be subject to assessment for the business or personal property. That means all the contents inside. Now, Marin hasn't really taken that position aggressively yet, but San Francisco has made a very aggressive position on that. It'll be very interesting to see how that plays out with the regulators at the state, the legislators, the public, and whether that kind of approach to assessing property spreads beyond San Francisco.
Well, it's pretty easy to catch people too, because all you have to do is just go on the Airbnb website and look at an address, and then you guys can cross-check it.
That and San Francisco, I believe, is getting direct information from Airbnb on their accounts, and that's a requirement from that, and or whoever the other players are in that industry.
It's not like Facebook and trying to do the privacy type thing.
So there's several things that impact is the transit occupancy tax, business licenses, property tax. All these things could come into play, something for people to be aware of if that starts to play itself out over time.
I bet the hotels are behind that, because they're probably losing, because they have to pay hotel transit tax.
Absolutely.
Yeah.
Well, there's always a double-edged sword on these things. Where no free lunch is what you should always keep in mind if you're looking at Airbnb being your property. That looks like it could be subject to additional taxes, business license taxes, and other types of.
And that's one of the most interesting things about real estate in general is the market is not static. It's a very dynamic market, both
That's for sure.
residential and commercial. Another example is in Marin County over the last several years, we've seen homeowners exemptions go down, which suggests to me that there's a lot of investing in single-family homes where people aren't taking out homeowners exemptions.
Or how do a lot of the, I was gonna say, does everyone know about that? It's only $7,000, but
It's
do
only $7,000,
how many people
but
even think about it?
every tax bill, every notice we send out gets that information.
Yeah. No, I mean, I've seen it.
$7,000 of value, not
Of value.
$7,000 of tax.
Yeah.
That's correct.
Okay, I just want
If
to
it
make
were a
clear.
tax credit, that
That's
would be
correct.
nice.
Yeah.
That'd be helpful to. at
Rich,
least-
try that for the next time. Okay, we're going to count on you for that. So, guys, we have another minute before we have to go to break.
Well, I've got another headline here. It's talking about market bubbles. Of course, a lot of people wonder whether California cities are in a bubble, and this particular article says it's not a housing bubble. Home prices are just expensive. But it does say that they do say that prices in the San Francisco Bay Area are probably unsustainable at the rate they are going up right now. And this is bad for the local economy if high housing costs spur talented workers to move away. They say that we could be looking at a housing cost-induced economic slowdown because people can't make the housing market work.
And they're not building more.
Not in the Bay Area. So again, we talked about earlier in the show, we are starting to see housing, the rate of acceleration in housing prices is starting to slow in many markets in the Bay Area, and I would not be surprised if that continued.
Well, okay, guys, so we're going to go to another commercial break. Before we do, we've got something here again for the Weingarten Children's Festival. Not festival, but imagine your child cannot hear or speak. What do you do and where do you go? Check out the Weingarten Children's Center in Redwood City. This year, on October 29th, they're actually going to have a masquerade party. So check them out, okay? That's listenspeaklearn.org. Stay with us. The Best of Investing. I'll be right back. All right, that was good. Okay, that one I didn't mess up on.
Okay, do we have one more still?
Yeah,
We
Yeah,
got
we have
5
5
minutes. I'm going to go back in
minutes.
and
But it'll go fast.
So I'm going to say this is
5 minutes goes
three.
fast.
Yeah, it does, because we're supposed to kind of wrap up.
All right, so what about if I were to pass and I leave my property to my father? Is there an exclusion in that
Yeah,
direction?
sure, you can go Paris.
you can go
Yeah,
up
you
or
go
down.
up.
You
You
go
go
either
up or
way.
down.
You just can't go down
Absolutely.
sideways.
Yeah.
Yeah.
Yeah, okay, good. Yeah.
No hamsters either. Don't leave
Yeah.
it to hamsters.
We did have one really weird one, not talking
I was
about
going to ask
weird
for, I want to hear some weird stories.
You
If
know,
we can we get one?
Parents died and, their kid wasn't officially adopted, but lived with them forever, right?
Oh.
And then the parent died and basically had the kid in the family as if it was another child, and didn't work.
They just you're like, sorry.
Tragedy.
How'd you,
Nothing
I
we
mean,
can
do you have
do.
like, they have a different name, and that's how you guys, how would you guys even know?
Probably different name, but it, I mean, however it played itself out, but it was just.
Well, and you can't make an exception of the
Tragedies.
rule because then everybody's
can't.
going to,
There's no way.
yeah.
There's no way.
So
Okay.
if I'm going to wrap up,
Another interesting thing is that people maybe not know too much about is, like you talked about when they're in decline and
Yeah.
not, is what happens, right? Well, if they don't agree with an assessment, they can get an informal review or they can get an appeal. What's that process like?
Okay,
I think that's interesting to hear if we have time for it.
so I'll finish my.
Oh,
I need to
yes.
finish my
Yeah.
answer on the
pitch.
private money loans.
Yep.
And then I can wrap that up probably in a minute or so. And then you want to go? Do you have a question for Rich on just some? What was that?
About how do you appeal it? Is that-
Yeah, you could say, well, what if I don't agree with my assessment?
If you don't agree on the value.
So I'm gonna just go
have
right.
me finish, but then do you want to then ask ask Rich one more question before we go? That way,
And I'm gonna keep my answer pretty short so that
Okay.
there's enough time for you guys to figure out.
yeah, got it.
Okay. Ready? Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hanf and Mark Cooper. Mark, why don't you finish up there?
So the question we had in the last segment was, why is a private money loan more expensive than a conventional loan? And basically, because we use private capital to fund our loans, there's only a price at which below that, private parties are not going to make their money available. And what we found in the Bay Area is that number is right around 8%. That seems to be the point at which if it goes below 8% in terms of their return on their mortgage investment, then they have other options. There's REITs, there's muni bonds, there's all kinds of ways that you can get tax preferences that boost your effective yield, since when you invest in a note, it's pure interest, ordinary income. So right now, if I pay my investor 8%, I need to add a spread to that to help with our business model. So that's when I say maybe a 9% loan, that's about market, but between 9 and 10%, that seems to be about what private money is priced at. But because people don't use our loans for that long a period, yeah, it seems like it's expensive money. It's more than double the cost of bank money. But when you consider that we're really, for the most part, a bridge, a stepping stone to conventional financing. People use us to close when they can't close financially, and then they pay us off. Most of our loans have no prepayment penalty or minimum interest guarantee. So if you pay us off in 6 days, 60 days, or 6 months, it's fine with us, and we expect people to pay us back quickly. So again, the note rate notwithstanding, really the private money loan industry exists to basically help rescue you when your transaction is in trouble, or help you acquire real estate when the banks won't make you a loan. For example, fix and flippers. Flippers haven't been able to get bank loans unless you're basically paper qualified, and most flippers that we work with are not. They live from project to project. So again, for more information on how you can use a private money loan, if you're a realtor or mortgage broker and you have a client that's stuck in a deal, give us a call. We love taking loan scenarios. I mean, we get calls all day long with pitching a scenario. Hey, can you help in this situation? We can say yes or no very, very quickly. We know exactly the type of transactions we can help you with and what we're looking for. So for more information, our website is pacificprivatemoney.com. That's pacificprivatemoney.com. Or if you want to pick up the phone and leave us a message, call you back on Monday, 415-883-2150.
They can also call you for investing with you and earning over 8%.
That's right. And next week on the show, we're going to talk a little bit about mortgage investing and how you can earn 8% or more on your money investing in mortgage-backed instruments.
Okay, so Rich, before we let you go, we do have a question for you, and it revolves around what do people do if they disagree with the value that you've given them?
Really? Anybody disagree with their assessment? I can't imagine.
See if you can answer this in about a minute and 20 seconds.
So, that's a great question. And there's really 2 ways most counties do it. And there are some differences between counties. But generally, you can go to the assessor and ask for an informal review of the assessment, with that, which can be very casual. The assessor may ask for some information, try to get some help understanding the details of the property. But if that doesn't work, you can go to an assessment appeal. Here in Marin County, which is a little more formal, here in Marin County, we accept informal assessment reviews until the end of October, beginning of July to the end of October, and formal assessment appeals beginning of July to the end of November. Many counties, that appeal period ends in the middle of September. The appeals board, if you do have to go that far, but most of the time it can be resolved informally. The appeals board is not court. It's a setting that can be addressed with most anybody to help with their homeowner's assessment if that need be. And there's lots of information to help prepare.
Well, appreciate that. So what's your home number if people want to call you? No, we don't want to do that. Okay, you can just go to...
Go back to the website. There's training videos on the Board of Equalization website to help guide people through the process.
Well, thanks, Rich.
Very good. I really appreciate that. So next week, we're going to have Catherine Harris, CPA, on. We'll ask her some tax questions. And thank you again, Rich Benson, for joining us.
My pleasure.
Tax Association. And, of course, Mark Cooper, our commercial broker co-host. And once again, Mark Hanf, my co-host from Pacific Private Money, providing mortgage investments that are currently yielding over 8%. So, quick thoughts for the day here. Worry is the interest paid by those who borrow trouble. Mark, is that true? Do you charge worry on your loans? No.
Double interest.
Okay. And no, that's only for people who borrow trouble, not money. And would transformers buy life insurance or car insurance? All right. Tune in next week to The Best of Investing. Catherine Harris will be joining us. We're going to be giving out more valuable information about mortgage investing, where people can earn in excess of 8% in conservative mortgages. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Good.
All right.
Man.
These guys are pros.
How many times have you been here?
This is my second time.
Second time. These guys are